Hello and happy Friday, everybody. It is Brian McCarthy at Compass in Hoboken. Today is Friday, the 13th of May. And coming at you today with our market monitor, going to talk about why this is not a housing bubble that is about to pop, even though rates are going up. Talk a little bit about affordability right now compared to the rest of the year, and also just a market forecast of what we can expect for the rest of the year and for the next 3 or 4 years into the future here. All right, so welcome to May, everybody. All right, first off, most importantly, why we're not headed for a housing bubble. And I really think this is important today, and I'm going to kick off today with this topic because I've been hearing this word a scary amount of times over the past week. It is not a housing bubble, people, and I'm really sorry to say, if you're a buyer out there looking to buy and things are becoming unaffordable, it's not this thing that's going to pop and next year it's going to be great. And here's a bunch of reasons why. It's not just my opinion. There are some fact-based studies here that are going to back this up. So first of all, home price appreciation since World War II, which is really when the modern housing market started with the GI Bill and people being encouraged to buy homes and settle down. So since 1945, with a dip after, for obvious reasons, after the real housing bubble in 2007 and 8, home prices have been historically appreciating and will continue to do so. A big reason why the one and only housing bubble that happened in 2006, 7, 8 was because of forbearance and people defaulting on loans. And that number has gone down steadily since the beginning of the pandemic. Monthly number of loans in active forbearance, as you can see here in this chart, have just gone down and down and down. And that was a real issue that people were scared about as jobs were being lost, the economy slowed down right after COVID started gripping the world, but that has gone down steadily, and that's actually a good statistic for everybody, and is at a very, very at an all-time low here, at least for the past several years, which is encouraging. So one of the big reasons why the housing bubble burst, what was that, 16 years ago, 15 years ago, is just not happening right now. Loans up on so this is just kind of a breakdown of loans for the existing forbearance program. So people that are on this program right now, broken down here, 37% of those were paid in full since this forbearance program started 2 years ago. 44.6 are in workout and repayment plans. So this blue section here are modifying or in loan deferral, and 18% are still in trouble. So this is, this obviously makes up 100%, but this is making up 100% of, less than 1% of the market here. So let's keep that in perspective. So out of that 1%, 37 or more than a third are, paid off in full and fine. And a huge chunk here, almost half, are in a repayment program, and then just under 20% are still technically in this trouble area. So again, this is from the period of June 1st when this program started through the end of the month before, March 31st. Lending standards are nothing like they were in the 2000s, and that is a very good thing. It is a lot harder to get a mortgage right now with a lot of the Dodd-Frank rules and things that they put in place, which caused the housing collapse 15 years ago. So let's start off with the red part. The product risk is basically the risk of the loan products that they have out there. Things like ninja loans, no income, no job approvals. If you've ever watched The Big Short, if you haven't recently, I really recommend it. It's a great movie and has a lot of insight into why this happened. But loan products and the products themselves are a lot riskier, or a lot less risky now, that's the word I'm looking for, and borrower risk is a lot lower as well because just the loans that are getting approved are for people that have assets, that have a decent amount of income and good credit. Foreclosure activity is at an all-time low. So U.S. properties with foreclosure filings at the end of the year 2021. So right here, after the housing collapse, a lot of foreclosure activity. I mean, up almost to 3 million here in 2019, 2010. 2011 has gone steadily down and is now at a fraction of what it was when it was really bad. Tighter lending standards since the crash. So this is just based off of credit score. This is the volume of loans in billions for people that are getting approved for a loan with a credit score less than 620. That was huge leading up to the crash 15 years ago, and now is at, again, a fraction of what it was before. And the folks that are getting these loans definitely deserve them and are still loan worthy. So the risk there is very low. Mortgage debt is not a challenge anymore. So this is household debt service ratio for mortgages as a percentage of disposable income. So if you kind of consider this here is so total quarterly required mortgage payments divided by the total quarterly disposable personal income right now is the most affordable it's been since this was starting to get tracked in the 80s. So at its peak, in October 2007, it was at 7.2%, and we're at almost half of that today at 3.8% of people's total disposable income going towards their monthly mortgage payments. So let's take a look at what is ahead for the national housing market, shall we? Lots of reasons why it's a good time still, even as mortgage rates are going up, to buy a home, because you get to realize a lot of appreciation here over the next several years. So this is an estimated home price performance as forecasted at the beginning of the year here in Q1 2022. Home price performance has been up huge this year and is looking to even out. But here for the rest of the year, the average is forecasted to be 9% over the year. And then we're going to decelerate, but not decline or depreciate whatsoever over the next 4 years. So 2023 to 2026, it's going to cool off a little bit, but you're still going to realize about 4% appreciation every year, which is awesome. So if you have equity and you keep building equity in your home, that asset is just going to grow and grow. Cumulative house appreciation by 2026, as forecasted when people were broke up just into 3 categories here between the optimists, all the panelists, and the pessimists. Even the pessimists were thinking probably going to go up 10.3%, optimists saying almost 50%. So here's the forecast just by the big groups here that are involved in housing and loans. The average of all these 7 groups, people involved in housing right now, the average of their forecast here just for the rest of the year is 9%. So that's where we got the slide or the data for the chart 3 slides ago, is that 9% here. But it ranges anywhere from 10.8 to 6.2 as the most modest. All right, I like quotes here. So author of Calculated Risk blog said, based on the current estimate for the peak Fed funds rate, the 30-year fixed mortgage will likely peak between 5 and 5.7. So that's pretty much where we're at right now. There is some variability in the relationship, so we might see rates as high as the low 6s. This all depends on inflation and the Fed funds rate, but I don't expect rates to move much higher than the current rate, although 6% is possible. And really, that's going to become kind of the new norm. I mean, I feel like obviously it's alarming at how fast rates have gone up here over the past 5 months. But after a while, when they even out and things become a new normal here in the 5s for the next several years, it's, think about how quickly normal becomes. This is just going to become the new normal, and that's what we're going to be looking at for the next several years. Let's look at affordability here a little bit. So new data from the Harris poll show that 84% of Americans plan to cut back on spending as a result of price spikes. So more than 70% of respondents said that they're feeling the effects of inflation, and most of those effects are felt at gas prices or at the pump and at grocery stores. So this is a change in monthly mortgage payments. This is, I'm not going to say cool, but very interesting to see. So let's say you have a loan amount of $300,000. We're just looking at the principal and interest payments only. So if you were to you would have gotten a loan in the beginning of the year in January 2021, when loans were, or the mortgage rate was artificially low to prop up the economy after the pandemic, 2.73, your monthly payment was at $1,221. So as this has increased over the months, actually, sorry, that was the beginning of last year, we get to the current rate, and this is national average right now, 5.27, and looking maybe at what it's going to be in October. Your monthly payment here has gone up almost $500. So things are definitely becoming less affordable. That's just taking a certain amount of buyers out of the market. But I want to kind of take this into perspective, especially for our area here of North Jersey and the Manhattan, New York City metro area, and just bring this home a little bit and show you that there is a lot of people, and I just posted this really cool article on my link tree in my Instagram bio. It's talking about how Brooklynites are calling the Gold Coast here, so that's Hoboken, Jersey City, Weehawken, and West New York, the new Brooklyn, because there are, as people, okay, so there are a certain amount of people that are getting priced out of buying in our area and are looking in other areas. Well, the same thing is happening in New York and Brooklyn, where people have, a slightly higher budget, where let's say they have $1 million and they need a 2 or 3 bedroom place. Well, you can't get that in Manhattan or even Brooklyn anymore. So they're coming here, looking in this Gold Coast area and finding a lot of value, if not in, Hoboken or Jersey City, which are kind of traditionally the more expensive areas. There's a lot of value to be had in Jersey City Heights, or other neighborhoods of Jersey City, certainly Weehawken and West New York. So although I'll just reiterate, although there are people getting priced out of our market currently, there are an equal amount, possibly more people that are getting priced out of a more expensive market and coming here. Let's just highlighting these examples I just had. So affordability approaching kind of historic normal levels. So obviously a lot of people today that are in the market have not been in the market or been buying homes for the past 30 years since this started in 1990. But through 1990 today, this is kind of looking at housing affordability. So the higher it is on this chart, the more affordable things were. So right after the crash, when there were a lot of distressed properties on the market, things were very affordable. If you had money and you were looking around, you could buy you had a big option, a big range of property that you could buy. This held true, into the 2010s here, and even to today. It's been dropping a little bit, especially as mortgage rates are getting higher. But that being said, like I said a couple minutes ago, this is just going to be the new normal. And if you look at it here, things were somewhat less affordable from the 90s to the early 2000s. Now we're kind of back to that normal level, and this is going to be kind of our new normal. A market research economist at National Association of Realtors, NAR, the average consumer is spending an additional $429 monthly for items other than shelter. So while average weekly raises rose $212 per month, so the consumer is basically this gap here between the 429 and the 212 is $217 per month. This means that the average consumer will be looking for a home that is roughly $41,793 cheaper. I think this is this quote is interesting, although probably a little bit too specific to a certain segment of the market, but I can relate to it because things, not just housing, are getting more expensive. Although with just interest rates across the board, hopefully tamping down on the inflation lately. I mean, the latest numbers on inflation are that it's going down, or at least leveling off. So that is good news. But yeah, certainly people are looking for cheaper homes to kind of mitigate that pressure that we have on our wallets. But that, it is what it is. So if you are a buyer there that's still in the market, I encourage you to find something, hold on. The good news is there's less competition right now. So if you were getting beat out by multiple offers and you can hold tight, just make a good offer on the next place you see, and you probably have much less competition. So I just kind of want to sum this all up by saying and asking a question. Ask yourself, do I have a relevant market opinion based on facts? So if you've been reading headlines and not really diving into the actual factual data there, and hearing and possibly even believing the word bubble around what's happening now, I really encourage you to take a look at everything that's going on and dive deep and really consider, is that opinion or the opinions you hear based upon the facts that we see, and really kind of analyze that. So I'm going to leave you with that question today. If you want links to any of these articles or quotes or anything that I'm using, I'd be happy to share. Some of the slides themselves have the source at the bottom, but always happy to hear from you guys and like to hear what you think. Are you still in the market? Are you still looking? Did you get priced out recently? Are rents, if you were priced out, or you're looking at the difference, like is renewing your rent at the higher rate more affordable than staying in the market here and buying? I'd like to hear your opinion. So feel free to post below, or you can reach out to me directly. My cell phone is 617-851-9141. You can reach me on Instagram at Bry Says, or my email is brian.mccarthy@compass. So hope you all have a great day and a great weekend, and I will see you here, same place next week. Take care, everybody.